Welcome to HouseLux Estate, your trusted guide to smart investing and trading. We're here to make the complex world of finance accessible to everyone, giving you reliable, simplified, and actionable insights into the ever-evolving markets. Our mission is to empower you in your investment journey, whether you're a seasoned trader or just starting out. We believe that with the right tools and understanding, everyone can be successful in their financial endeavors. In today's video, we will delve into the art of using technical indicators for day trading. Before we get into the technicalities, it's crucial to understand what day trading is. Picture this, a bustling stock exchange where traders buy and sell stocks, bonds, options, and other financial instruments, all within the span of a single trading day. That, in essence, is day trading. It's a fast-paced world where quick decisions can lead to substantial profits or losses. Unlike traditional investing, where you hold on to assets for months or years, day trading is all about short-term strategies. Every morning, day traders start with a clean slate, and by the end of the trading day, they aim to be fully flat, which means they hold no open positions overnight. It's a high-stakes game of timing and precision, where the goal isn't just to make money, but to outperform the market on a daily basis. Now that we have a basic understanding of day trading, let's explore the role of technical indicators. Technical indicators serve as invaluable tools in a day trader's toolbox. But you might ask, why are they so critical? Well, these indicators are like the secret sauce to a successful day trading strategy. Think of them as the compass guiding traders through the tumultuous seas of the stock market. They help traders predict future price movements based on historical data, thereby allowing them to make informed decisions. Picture this. You're in a dark room, looking for a way out. Technical indicators are like the flashlight that illuminates your path, revealing potential pitfalls and opportunities. Whether it's the relative strength index, moving averages, or Bollinger bands, each technical indicator serves a specific purpose and provides unique insights into market trends. They offer a glimpse into the market's past, present, and potential future, allowing traders to navigate the market with increased confidence and accuracy. Now let's break down how to use these indicators. The process of using technical indicators starts with understanding the different types of indicators. First, let's consider trend indicators. These are the roadmaps that guide you through the terrain of market movements. They help to identify and follow the direction of a trend. Moving averages, for instance, are a popular type of trend indicator. They essentially smooth out price data to form a line that tracks the trend. To use them, you would buy when prices are above the moving average line and sell when they drop below. Next, we have momentum indicators. Think of these as your speedometers. They show the speed at which the price of an asset is moving in a given direction. The relative strength index, or RSI, is a classic momentum indicator. It oscillates between 0 and 100, indicating overbought and oversold conditions. If the RSI crosses above 70, the market might be overbought and it could be time to sell. Conversely, if it drops below 30, the market might be oversold, signaling a potential buying opportunity. Then, there are volatility indicators. These are your weather forecasters, giving you a sense of the storminess in the market. They measure the rate at which the price of an asset increases or decreases for a set of returns. Bollinger bands are a commonly used volatility indicator. When the bands contract, it suggests that market volatility is low. However, when the bands widen, it implies high volatility. Traders often use this to anticipate sudden large moves in the market. Lastly, we delve into volume indicators. These can be likened to your market crowd monitors. They track the number of shares or contracts traded within a specified period. On balance volume, or OBV, is one such volume indicator. It uses volume flow to predict changes in stock price. An increase in volume usually precedes a change in price. So, if the OBV increases while the price stays steady, expect an upward price move. On the other hand, if the OBV decreases and the price remains constant, a downward price move could be on the horizon. Remember, each type of indicator serves a unique purpose and can provide different insights into the market. It's like using different tools in a toolbox. You wouldn't use a hammer to screw in a nail, right? Similarly, you wouldn't use a volatility indicator to identify a trend. However, when used together, these indicators can provide a comprehensive picture of the market. Now that we know how to use these indicators, let's discuss some key points to keep in mind. While technical indicators can be beneficial, they aren't foolproof. Now, this may sound like a dampener, but it's a crucial point to keep in mind when venturing into the world of day trading. Let's delve into some key points that will help you navigate this complex yet fascinating terrain. First up, the importance of using multiple indicators. Think of it as assembling a jigsaw puzzle. One single piece isn't going to give you the whole picture. Similarly, relying on a single indicator could lead you to make inaccurate predictions. So, it's advisable to use a combination of indicators, like trend lines, moving averages, and volume, to get a more comprehensive analysis of the market. Next, it's essential to understand that technical indicators are lagging indicators. They're like rearview mirrors in a car. They show you what's happened, not what's about to happen. In other words, they're based on past market data. While they can help predict future trends, they're not psychic, so always combine these indicators with real-time market analysis to make informed trading decisions. Thirdly, while technical indicators are significant tools, they're just one part of a comprehensive trading strategy. A well-rounded strategy includes understanding market fundamentals, managing risks effectively, and maintaining a disciplined approach to trading. It's like baking a cake. You can't just rely on the flour. You need eggs, sugar, butter, and a pinch of salt to make it all come together. Lastly, don't let the allure of potential profits cloud your judgment. Always remember, the market is unpredictable and volatile, so don't trade more than you can afford to lose. It's akin to walking a tightrope. You need to maintain a perfect balance to prevent a fall, so there you have it. The key points to keep in mind when using technical indicators for day trading. While these indicators can provide valuable insights, they're not a magic wand. It's important to use them wisely and in conjunction with other trading tools and strategies. Remember, the key to successful day trading lies in understanding and effectively using these indicators. It's not about guessing the market direction, but about making educated predictions based on a careful analysis of the available data. That wraps up our discussion on using technical indicators for day trading. We've journeyed through the exciting realm of day trading, exploring the integral role that technical indicators play in guiding your decisions. We kicked off by defining day trading as the quick buying and selling of financial instruments within a single trading day. We established that its rapid pace necessitates a deeper understanding of market trends and price movements, which is where technical indicators come in. These invaluable tools provide a visual representation of market data, helping you to identify patterns and predict future price movements. We underscored that while they aren't foolproof, they can significantly increase your odds of making profitable trades when used correctly. We then delved into the step-by-step process of using technical indicators. We highlighted that it starts with choosing the right indicators that align with your trading strategy and risk tolerance. We emphasized the importance of using a combination of different types of indicators, trend, momentum, volatility, and volume, to gain a comprehensive view of the market. We explored how to interpret these indicators with the understanding that they generally signal a buy when they move above a certain threshold and a sell when they fall below. We also touched on the need to adjust these thresholds based on market conditions and your personal risk tolerance. In our key points section, we reiterated that technical indicators are not a standalone solution. They should be used in conjunction with fundamental analysis and a robust trading plan. We stressed the importance of practice, advising you to use demo accounts to hone your skills without risking real money. Lastly, we cautioned against over-reliance on these tools, reminding you that they are merely aids, not guarantees of success. Remember, the world of day trading is dynamic and ever-changing. It demands ongoing learning, flexibility, and a keen eye for detail. Technical indicators, while not a magic bullet, can be a powerful ally in your trading journey, providing you with insights that can guide your decisions and potentially lead to greater profits. As we conclude, let's not forget that the road to successful day trading is paved with knowledge, patience, and discipline. And while the journey may be challenging, the rewards can be immensely fulfilling. Thank you for joining us today at HouseLux Estate. Don't forget to subscribe to our channel for more insightful trading content. Happy trading!